Pfizer has had a horrific 2023, down 42%. However, it has started 2014 with a bang, up 4.24% on the day. And today we're going to find out, is this still undervalued? Is it one we should be holding, or is it one we should be considering selling? As always, we will run it through our updated valuation model to get to the intrinsic value, what we believe to be the acceptable buy price given our investor margin of safety. We'll take a very quick look at how their revenues have progressed over the last 5 years, as well as their bottom line net income. We'll take a quick look based on their updated earnings, their total cash versus total debt, a quick health check. And as always, we'll compare them to how the industry is doing as a whole over the last 5 years. We'll get a refreshed look on their dividend safety as well as those financial metrics. We'll also take a look whether institutions are still buying in 2023 quarter 4. And we'll also have a very quick look at the bull case for Pfizer in 2024 to see where this company can be heading. So, as we discussed, a horrific year in 2023. It is picking up right now, and we can see it is still towards the mid to lower end of the 52-week range and offers a yield of around 5.84%. Now, if we do look at that forward PE, it is sitting at just under 19, and we'll compare that to essentially their 5-year average shortly. Over the last 10 years, well, you'd be pretty much nearly flat on your investment, although that doesn't include those dividends reinvested. And we can see it hit its peak at the back end of 2021 at around $60. So this price is currently half of its all-time high. Now, very quickly then, top line, what we like to see, 3 to 7% growth. It shouldn't surprise you, $41 billion in 2018, December 22, $100 billion, and it looks likely they're reporting their December 2023 soon, coming in at around $68.5 billion. Now, if you do want to see us do an in-depth analysis of their 2023 annual report, don't forget to hit that subscribe button so you can be notified when it drops. So it is understandable we see 2018 to 2020, the period before COVID, remaining fairly flat, but that COVID did give them a huge boost to their top line, doubled in 2021, 50 or 40% increase as we can see here in 2022, and then it has dropped due to COVID no longer being relevant, one could argue. So how does their bottom line look like? Well, 11 billion reported in 2018, 31 billion in 2022. And we can see it did increase to 2019 before falling and then picking back up all the way into those 2 COVID years. But again, similar to the top line, we are expecting a huge dip. So we'll touch upon that shortly, whether or not they have the capabilities and facilities to increase continually their top line and bottom line moving forwards without COVID. Now, in terms of a quick health check, well, total cash, 19 billion 2018, latest quarterly report, 44 billion. So they are holding more cash than they did 5 years ago. And also, one of the things they are doing, rather than doing pure organic growth, we'll touch upon this shortly, they are also looking to buy smaller companies so they can grow quicker, as they do sit on quite a lot of cash after that COVID bump. Now, numerically and directionally, their total debt, we can see it has gone from 42 billion to 64 billion. So whilst their cash has increased, so has their total debt, and we'll analyze some of those metrics around dividends and the net debt to EBITDA shortly. Now, in terms of the industry, last year we actually see Pfizer as one of the worst, if not in fact the worst, down 39%. We can see a few others negative, with only 2 companies, AstraZeneca, barely making a positive total return in 2023, and we see ZTS probably the best performer, as we can see, up 35.66%. Now, when we analyze the last 5 years, Pfizer is the worst performer still, not just on 2013, but also over the last 5 years. And we have some notable names, AstraZeneca as well as ZTS, up quite strongly over that period. So one thing to bear in mind, it hasn't performed greatly, but as always, past performance is never an indicator for future. 68% institutional ownership, we see around 11 billion of outflows over the last 12 months, and in the same period 96 billion. So as always, institutions have been buying a significant amount of Pfizer shares, with the largest being in quarter 2, 74 billion. Quarter 3, a little bit more selling than buying. Quarter 4, not much more movement by these institutions. So before we jump into the analysis, the valuation, we can take a very quick look. We have this article from Nasdaq.com, whether or not Pfizer is a good stock to buy now. Now, a few things they do highlight. We can see Pfizer plan to reduce the cost by around 500 million. And what they're essentially saying is they're increasing their adjusted earnings per share $2.05 to $2.25, which will be up from $1.55 in 2023. However, that COVID bump gave them a $6.58 per share in 2022, and we'll analyze that within the metrics. So we can see they aren't expecting 2024 to be higher than their pre-COVID, or in fact due to their COVID numbers. They are expecting it, however, to be higher than the previous year. Now, the bull case, we have a few things to comment here. They do have a fairly high yield at 5.84%. They have increased their dividend each year for over a decade. And in terms of the levels, they do believe it to be cheap, trading at 12.7 times 2024 earnings. Now, as we mentioned, COVID-19 sales did affect their top line as we took a look and analysed the income statement, but they do see effectively Pfizer will need to come up with ways to essentially propel their top line, whether it's introducing new drugs to the market or widening their portfolio by their acquisitions, as we mentioned earlier. Recently, Pfizer did acquire a cancer specialist company for $43 billion, which they are looking to add $3 billion to their top line year on year. And finally, they are expecting to add around $25 billion in additional sales by 2030 on the back of their acquisitions as well as their organic growth. Now, we'll touch upon their target price through the model that we look at, but we can see here 17 analysts tracking Pfizer, 7 recommend a strong buy, 1 recommending a moderate buy, with 9 recommending a hold. So we can see there are no sell signals by these analysts for Pfizer, with an average price target of $36, meaning around 22% from the current levels. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And as we run through the model, do click on that pinned comment below if you want to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list. So jumping straight in, we have Graham's valuation model. We have the stock ticker symbol PFE, earnings per share at 183, a long-term growth estimations by analysts at 11, with that current yield on AAA corporate bonds, giving an intrinsic value of $31.44. With the current market value, we have a signal of undervaluation. But as always, remember, bear in mind, we're not looking at any of these models in isolation and will draw conclusions towards the end. So then we have the multiples valuation model. We have companies in a similar sector and size. We have their stock price, earnings per share, and their PE multiples. We have the average PE at 20.88 multiplied by the earnings per share of Pfizer to give an intrinsic value of 38.2. With a market value, we can see again another signal of undervaluation. We're then running into the dividend discount model where we have the yearly dividends, as we can see average growth rate of 3.83. Now, we have gone more conservative in our estimations. As always, if you click on the pinned comment below, you can run your own estimations through. However, we've gone for 3.25. As we can see, the last few years have in fact been below 3. This gives an intrinsic value of $35.65. Market value of 30, again, another signal of undervaluation. Jumping into the DCF model, we have the free cash flows year on year. Average growth at 12%. Do know analysts are expecting negative free cash flow movement. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value. Divide by shares outstanding, we get an intrinsic value of $40.50. Again, another signal of undervaluation. Now we get to the intrinsic value. And before we jump into this, we can take a very quick look at their dividend safety and financial metrics. We see the dividend safety score of 75. It is safe. Market cap $163 billion. It is a mega cap company. Now, in terms of the recessionary metrics, for those that see a recession this year, they did in fact cut the dividend during the last recession. They had above average growth, bearing in mind that was around negative 12% for companies in the S&P 500, and they outperformed the S&P with a negative 45% return versus the S&P's negative 55%. A very poor dividend increase in December 23, although it's not surprising, 2.4%, which is below the 4% we advocate on the channel, just to keep up in line with inflation. Plus 5% over the last 5 years, over 6% over the last 20 years. So at least you're getting above an inflation increase year on year, as well as getting a fairly high starting yield of 5.84%. They've also been increasing the dividends over the last 12 years. Now, in terms of dividend yield theory, remember, it shows a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. Bearing in mind, we'll draw conclusions at the end. Forward PE, though, it is higher than the 5-year average at 20 versus 12.1. Comparing that though to the healthcare sector P at 17.7, Pfizer is slightly higher with its score of 20. Now, in terms of free cash flow payout, earnings, remember, susceptible to manipulation by management through accounting, so we tend to ignore this. Below 60% is my personal preference for the majority of companies. Now, we do see it pretty much below that, bar 2019 and 2020. The following 2 years, in fact, below that. 2023, it is expected to be 112%. Now, this is a red flag indicator just to let you know what this signals. It means that in 2023, they are expecting to pay out more in dividends than generate in free cash flow. So something just to bear in mind. Free cash flow per share, well, 238 to 464 in 2022. So yes, it has increased, but do note before that COVID bump, 2013 to 2020, it did rarely move and was fairly flat year on year. 2023, it is expected to drop down to 145. But remember, from the article we did take a look at, they are expecting to increase their 2023 free cash flow per share as well as their 2024. Sales growth, well, whilst we look for a steady moderate growth of 3 to 7%, we can see here it is very inconsistent. And again, even before COVID, we do see it have negative growth pretty much the majority of the period. And even those that are at 0 and 2%, it's not keeping up with inflation. So in real terms, it is in fact decreasing. 2021, 2022, no surprise, double-digit increase, although do note 2023, it is expected to drop 31%. Something just to bear in mind, although they are expecting to turn this around, not just through organic growth, but also acquisitional growth, as we discussed. Total sales then, 51 billion in 2013, 100 billion in 2022, with 69 billion expected in 2023. Now, they have done share buybacks, 6.9 billion in 2013, 5.73 in 2022. So over the period, they have returned excess cash to investor pockets. Now we look at the ROIC. Remember, 10% or more is what we personally look for, just so then we have faith that management are able to effectively allocate their capital. Again, pretty consistent around that 10% before COVID. After that, 23, 29. But as we can see, 2023 at 5%, a red flag indicator, something just to bear in mind as an investor or potential investor. Now, operating margin and free cash flow margin, lots to love before 2023, so something again to keep in mind. Whilst it does look fairly good on both fronts, on 2023, both operating margin and free cash flow margin is expected to drop quite significantly, so something again to keep in mind. There are a few red flag indicators we have noted. Now, the net debt to EBITDA, earnings before interest, tax, depreciation, and amortization, shows us two things, the dividend safety as well as the balance sheet strength, with these numbers effectively showing us the number of years it would take the company to pay off all of their debt net of cash on hand. 2021, 2022 at 0.41, very positive, very good signal. 1.08 expected in 2023, so yes, it is expected to more than double, but it is still below that 3. So in terms of the valuation, we did run through all these models. Now let's get to the intrinsic value, which for this episode of Pfizer comes to $36.45. Now, as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, click on that pinned comment below so you can grab a copy of the model to get your own intrinsic value and acceptable buy price for companies in your own portfolio or on your watch list. So margin of safety, we start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. For Pfizer, that is around $32.80. At 15%, around $30.98. And at $20, around $29.16. So you could argue Pfizer right now still has a margin of safety of between 15 to 20%. In terms of Wall Street and a buy, well, they do believe it will hit around $35 over the next 12 months. So they see around 20% upside to the current trading price. So in conclusion, for Pfizer, we see around 15 to 20% margin of safety based on our estimates and judgments, with Wall Street expecting around 20% upside over the next 12 months. As always, let me know your thoughts in the comments below. I know a lot of you were adding Pfizer when it was reaching its 52-week low at around $25, $26. Whether you're looking to buy now or whether you're looking to sell for a quick gain, always good to drop your thoughts in the comments. Smash the like button if you've enjoyed the video, hit that subscribe and bell button so you are continually notified of these videos as they drop, and don't forget to click on that pinned comment below so you can get to the acceptable buy price and intrinsic value of companies in your own portfolio or on your watch list. As always, have a great day and catch you on the next episode.